Hi, everyone, and welcome back to Money Talks. Hey, Alexis, great to have you back on the show. How's everything going?
Things are great, Rita. It's always a pleasure to be here.
I've been thinking about getting more into stock investing, but honestly, some of the terminology feels a bit intimidating. I see terms like common shares and preferred shares thrown around, and I'm not entirely sure what the difference is. Can you break it down for us?
Absolutely, Rita. It's a great topic and fundamental for anyone looking to build an investment portfolio. Let's start with the basics. Equity securities. When you buy an equity security, you're essentially buying a piece of a company. The two most common types are, as you said, common and preferred shares.
So when people talk about buying stocks, they're usually talking about common shares?
Exactly. Common shareholders are the owners of a public company. If the company does well, the value of your shares can go up, which is called a capital gain, and you might also receive a portion of the profits in the form of dividends.
That sounds straightforward enough. What are the main benefits of owning common shares?
There are several. The biggest one is the potential for capital appreciation, meaning the stock price increases. You also have the right to vote on certain company matters, like electing the board of directors. In Canada, dividend income and capital gains get favorable tax treatment. Plus, for most public companies, their shares are easily marketable, meaning you can buy or sell them without much hassle. And importantly, you have limited liability, which means you're not personally on the hook for the company's debts beyond the amount you invested.
That limited liability part sounds pretty important. What about the downsides?
Well, the biggest risk is that the company might not do well, and you could lose your entire investment. Also, the company's board of directors decides whether or not to pay dividends, so that income isn't guaranteed. And while you have voting rights, as a small shareholder, you won't have much say in the day-to-day operations. Another thing to remember is that in the case of bankruptcy, common shareholders are the last in line to get paid, after creditors and preferred shareholders.
You mentioned dividends. How did those work exactly?
A company's board of directors decides on the dividend policy. Some companies pay a regular dividend, which they aim to maintain. Others might pay an extra dividend if they have a particularly good year, but that's a one-time bonus. When a dividend is declared, the company sets a dividend record date. If you're a shareholder of record on that date, you get the dividend.
I've heard the terms cum dividend and ex-dividend. What do they mean?
Great question. When a stock is trading cum dividend, it means the buyer will receive the upcoming dividend. After a certain point, the stock trades ex-dividend, meaning the seller gets to keep the dividend. The ex-dividend date is set by the stock exchange and is usually one business day before the dividend record date. So, if you buy the stock on or after the ex-dividend date, you won't get that dividend payment.
That's a key detail for investors to watch out for. What about a dividend reinvestment plan? I've seen that option offered.
A dividend reinvestment plan, or DRI, is a fantastic tool for long-term investors. Instead of getting your dividends in cash, the company uses them to buy more shares for you. This allows you to build your position in the company over time, often at a lower commission cost than if you were buying the shares yourself. It's a great way to take advantage of dollar cost averaging, which is investing a fixed amount of money at regular intervals regardless of the share price.
That sounds like a smart, automated way to grow your investment. Now, I've also heard of companies doing a stock split. What's that all about?
A stock split is when a company increases the number of its outstanding shares to make the share price more affordable for investors. For example, in a 2-for-1 split, if you owned 100 shares at $100 each, you'd now own 200 shares at $50 each. The total value of your investment remains the same, but the individual share price is lower. The opposite of this is a reverse stock split, or consolidation, where a company reduces the number of shares to increase the price, often to avoid being delisted from an exchange if the price gets too low.
That makes sense. Before we move on to preferred shares, I've been hearing more about responsible investment and ESG. How does that fit in with common shares?
That's a really important and growing area of finance. Responsible investment is about incorporating environmental, social, and governance factors into your investment decisions. So you'd look at things like a company's carbon footprint, its diversity and inclusion policies, and how it's managed. The idea is that companies that perform well on ESG metrics may be less risky and can deliver better long-term returns.
It's great that investors are thinking about more than just the bottom line. Now, let's switch gears. How do preferred shares differ from common shares?
Preferred shares are a bit of a hybrid security, having features of both stocks and bonds. The main difference is that preferred shareholders have priority over common shareholders when it comes to receiving dividends and in a claim on assets if the company goes bankrupt. However, they rank behind creditors like bondholders.
So they're preferred in the sense that they get paid first.
Exactly. And they usually offer a fixed dividend, which makes them attractive to income-seeking investors. This is different from common shares where dividends can vary. However, this fixed dividend also means that preferred shares don't typically offer the same potential for capital appreciation as common shares.
Are there different kinds of preferred shares?
Yes, there are quite a few. A key feature to look for is whether the dividends are cumulative or non-cumulative. If a company misses a dividend payment on a cumulative preferred share, those unpaid dividends known as arrears must be paid out in full before any dividends can be paid to common shareholders. With non-cumulative shares, if a dividend is missed, it's gone for good. Most preferred shares in Canada are non-cumulative.
That cumulative feature sounds like a nice safety net for investors.
It is. Another important feature is a callable feature, which almost all preferred shares have. This means the issuing company can redeem or buy back the shares at a specific price after a certain date. On the other hand, some preferred shares have a retraction feature, which gives the shareholder the right to force the company to buy back the shares. A hard retraction means the company must pay in cash, while a soft retraction allows payment in cash or common shares.
It seems like there's a lot of variety. What about the different dividend structures?
You're right, it can get complex. The most straightforward are fixed-rate perpetual preferred shares, which pay a fixed dividend forever, though they are usually callable by the issuer. Then you have floating-rate preferred shares, where the dividend payment changes, usually based on a benchmark like the Canadian Bank prime rate. More common these days are fixed reset preferred shares, also known as rate reset preferred shares. These have a fixed dividend for an initial period, usually 5 years, and then the rate is reset based on a formula tied to Government of Canada bond yields. There are also fixed floating preferred shares, which are similar but give the issuer more discretion in setting the new fixed rate after the initial term.
It sounds like investors really need to understand the specific features of the preferred share they're buying.
Absolutely. The details matter a lot. It's also worth noting that because their dividends are not a tax-deductible expense for the company, preferred shares are generally a more expensive way for a company to raise capital compared to debt. However, they are an option when market conditions aren't right for a new debt or common share issue.
One last thing on this topic. I've seen something called Canadian Depository Receipts, or CDRs. What are those?
CDRs are a fantastic innovation for Canadian investors. They allow you to invest in major U.S. and global companies like Apple or Amazon, but you buy them on a Canadian exchange in Canadian dollars. A key feature is a built-in currency hedge, which minimizes the impact of fluctuations in the Canada-US exchange rate on your investment returns. This is managed through the CDR ratio, which adjusts daily. They also make high-priced stocks more accessible because you're essentially buying a fractional share.
So it's an easier way to get international exposure without worrying about currency exchange?
Precisely. It simplifies the process and removes a layer of risk for Canadian investors.
This has been incredibly helpful, Alexis. You've really cleared up the key differences between common and preferred shares and all the related concepts. For our listeners out there, if you have any questions or your own experiences with equity securities, we'd love to hear from you. Drop a comment below, and don't forget to subscribe and share this episode to support the show. Thanks again, Alexis.
My pleasure, Rita. Happy to be here.